Did you know that JSW Steel has added capacity at a CAGR of 15% in the last 20 years? Did you know that JSW Steel has rewarded shareholders with returns of almost 25% CAGR in the last 10 years? Did you know that the top 6 companies in India have a market share of 64% in steel volumes and more than 90% incremental market share? Did you know that China has more than 50% of global steel demand? Join us this Saturday, 20th April at 12 noon for an overview on Indian steel sector.
A testing time for asset allocation. Gold is at an all-time high. Commodities are rising and soaring. Equity valuations are at the higher end of the valuation range when seen from a historic context. Real estate is certainly not in a zone where buying is compelling. So investors are having fewer and fewer asset choices as options. This year is going to be a test even for asset allocation, because with the exception of debt, most of the other assets look inflated in valuation and look somewhat less attractive. If they rise further, they would become unattractive. In this scenario, investors have to save, invest and manage their wealth. Growing your wealth in such a scenario can actually wait. Why do I say this? Because if you try to aggressively grow your wealth in a scenario where most of the asset classes are expensive, chances are whatever asset allocation you do, you could get affected. Your portfolio could see impact, which means that you need to develop a mindset to accept for a brief period of time. It could be 6 months, it could be 1 year, it could be even 18 months. Whatever it may be, you must learn to accept for that brief period of time that you must take the least risky option for most of your savings. And from there, you can take capital towards risk. This is easy to say, but extremely difficult to practice, especially when you find that socially everybody around you is extremely aggressive. Everybody wants to speed up their transactions even at these elevated valuations in each asset class. You are seeing the buying of homes with people queuing up from the wee hours of the day. You are also seeing that people are keen to invest in gold even at these valuations. You are seeing that the appetite for equity seems to be never ending. So the only asset class where there is a lot of disinterest today is debt. And the reason for that is we don't have visibility of inflation coming down. We are still not confident that in this calendar year inflation would come down so much that interest rates would start trending down. The moment that confidence comes to us, our view on debt will change. But by then, even that asset class would have left the station. People would have already bought it enough and moved it to a level at which its attractiveness would stand significantly diminished. Which means that if we are to board the debt train, we have to do it early and we need to push in as much of our savings into that asset class before the market gets comfortable with that asset class. So you need to actually take that chance. You may ask, what if things turn upside down or if they take much longer? Well, if things turn upside down, then you're going to see interest rates rise. But as of now, I think the probability of that happening is relatively low. But if nothing changes and inflation doesn't come down to the extent that gives comfort to the central bankers, then our expectations of interest rates could be too much too soon. So we may be expecting more than we ought to. In that case, we would need to wait for a much longer period of time. The gestation would be there. But I would factor in that gestation because you are still making 7% plus today, and chances are that this return is somewhat safe and stable. The question is whether interest rates will come down and increase the value of your portfolio significantly to raise the returns to a higher bar. And we don't know when this question will be answered. I would leave that answer to time and continuously invest in this asset class instead of taking higher risk in the other asset classes, or instead of chasing those asset classes at valuations where the risk reward is clearly not in favor. This may make many people ask a fundamental question. So are you saying that you should not invest in any equity asset? I am not saying that. You ought to be extremely selective in your investing, and you must buy only those equity assets which give you the comfort that you are not overpaying and that you have a fair chance of making a decent return. Because you are taking these high risks, you should see a fair chance of making your targeted return. If you don't see that fair chance, for the sake of just deploying, you should not buy equity. But where you see a fair opportunity to make those returns, you can take the risks of participating in equity selectively. This is a market where you need to be very selective. This is an economy where you need to say no to many things, but you should also not forget to say yes to the right things. In any market context, saying no to many things is one part. Saying yes to the right things is the more important part. Now, you need to know where you need to say yes. It could be debt, it could be very small pockets of the equity market, it could be very few sectors, it could be a few global stocks. You must be extremely selective. And this selectivity must help you make better investment decisions and also help you avoid poor asset allocation decisions. So your investment decisions should be winnable ones and also good from the prism of asset allocation. These aren't easy times, but these are very interesting times. And if you learn to do what you need to do for yourself, these could be the best of times for you, because you would have shown the right temperament, character and patience that will generate success for you when these tough times end. You have to do everything right today to get it right tomorrow. You can't wait to do that. And now is the time when you need to make those choices which will be rewarding and lasting in performance over the longer term. Thank you for watching this video.